Please allow me to introduce our speaker. R.B. Drennan, Jr. is Associate Professor of Risk Management and Insurance and Chairman of the Department of Risk, Insurance, and Healthcare Management at the Fox School of Business at Temple University. He has also been designated as Fox School Dean's Distinguished Teaching Fellow. Dr. Drennan received undergraduate degrees in economics, mathematics, and biology from Southern Methodist University. He earned his master's degree and Ph.D. in insurance and risk management from the Wharton School of the University of Pennsylvania. Dr. Drennan conducts research on managed care and employee benefits and has published articles in the Journal of Insurance Regulation, the CPCU Journal, Benefits Quarterly, and the Journal of Insurance Issues. Rob, we're pleased to have you here today.
Thank you, Marty, and welcome to all those who are participating in our first webinar. Again, this is Insurance Fundamentals for Policymakers. This is sort of Insurance and Risk Management 101. The remaining 3 webinars, as you can see, are insurance coverages, property and casualty. I'll be returning in a few weeks to do insurance coverages, life and health, and then the final installment in this sequence will be insurance regulation and legislation. So the topics that I'm going to discuss today are looking at insurance basics, also looking at some economic issues related to insurance pricing. Insurance pricing is very unique. Looking at some of the characteristics of the insurance product. Insurance is a risk management tool, how it fits broadly into managing risk for most firms and organizations. And then finally, we'll have a brief discussion as to why insurance operations are regulated. So we'll look at insurance basics first. Insurance is a fundamental tool to provide economic security to firms, individuals, and organizations. And so we first have to consider an icebreaker.
Thanks, Rob. Here's some food for thought for you and for our audience today. Issues associated with these types of insurance concerns may have an impact on your constituents. And we've listed healthcare insurance, homeowners insurance, workers' compensation, and auto insurance.
So to begin our discussion, we need to sort of get some terminology out of the way. These are pretty fundamental concepts that we will be referring to throughout our webinar, throughout the remaining webinars. So first we have to define what is risk. In insurance and risk management, we deal with a type of risk known as pure risk. And pure risk really is uncertainty regarding future outcomes. And in particular, when we say pure risk, it's uncertainty regarding a loss or events which might produce a loss. So you could think about in the future there might be 2 possible states of the world. Some random event could occur and you could have a loss, or the random event does not occur and you don't have a loss. There are certainly other types of risk which involve possibility of a gain. That's called a speculative risk situation. So gambling, for example, or buying stock. Those are examples of speculative risk. Speculative risk is not an insurable risk. Pure risks, generally speaking, are insurable. And so the types of risk that we talk about in insurance and risk management are almost exclusively pure risk events. We also have this term called a peril. A peril is defined as the immediate cause of a loss. So a fire is a peril, theft, floods, earthquakes, death, negligent acts. These are all examples of perils. They're also random events. So when they occur, when a fire occurs, there's a loss that's forthcoming. If no fire occurs, there's no loss. So the types of perils that I've mentioned to you are pure risk events. So a peril is the immediate cause of the loss. There also is something associated with insurance and risk management called a hazard. Hazards and perils are really easy to get mixed up, but they are very different. So I'll give you an example of a hazard. A drunk driver is a hazard as opposed to a driver who's not drunk. So in what sense is that a hazard? Well, anytime anyone gets behind an automobile, there's a possibility that they could get involved in an accident. If they're driving drunk, then the probability or the possibility of them getting involved in an accident is actually increased. So it increases the likelihood of a particular accident occurring. So it didn't cause the loss, but it made the peril, the accident in this case, more likely to happen. The second example of a hazard would be, let's say that you consider the distance of a structure from the nearest source of water, so a fire hydrant or firehouse. If you're right next door to a fire hydrant, if a fire occurs, then you have a reliable source of water, meaning that the fire will not be as extensive perhaps. If you're a long way from a source of water, and if a fire occurs, then the fire will go longer and the damage will be greater. So what we notice about hazards is that they don't cause losses to occur, but when we do have hazards, they increase either the frequency, or the probability, or they increase the dollar amount of the loss. So they don't cause losses to happen, but they increase the probability of the loss or the dollar amount that it happens. Now, hazards are important because they do affect insurance contracts, as we're going to see, and they're also an important part of how firms might manage risk in their organizations. Fundamentally, we consider losses. Losses are as a result of perils. Some losses are easily measurable. So most property losses, there's a loss to property, for example. It's pretty easy to measure the repair cost or replacement cost. If someone dies, there's a loss of income. That's easy to measure. But if someone dies, there may also be a loss of companionship or advice. That's not so easy to measure. Typically, we think of losses in insurance and risk management that can be measured because insurance contracts deal with losses that are easily measurable, as we will see. The next two concepts are related, loss frequency and loss severity. So to give you an example here, suppose that you were buying a firm and you looked at this firm's financial statements. You looked at their balance sheet and their income statement. And on their income statement, you noticed an expense item called self-insured workers' compensation losses. So, of course, states require, virtually every state requires firms to provide workers' compensation insurance or workers' compensation coverage for their employees who are injured on the job. Some states allow firms to self-insure, to not buy an insurance contract, to simply pay for those losses themselves. So if you were buying a firm, you're buying the assets, the liabilities, and all the risks associated with that firm. So if you were to see that self-insured workers' compensation losses was an expense item, and it was $1 million, then you might want to dig further and know, well, how did we get to that $1 million figure? Did we have one workplace accident, for example, that caused someone to be severely injured, and the amount of that loss is going to be $1 million? Or did we have 10 workplace accidents, and each accident cost $100,000? Both examples would yield $1 million, but in terms of how you got there, it would make a big difference from a risk management perspective. So some events, some types of losses or perils, are more what we call low frequency events or low probability events. Some are very, very low probability events. So a Hurricane Sandy type situation, floods are not unusual, but a Hurricane Sandy situation was a pretty low probability event. But when it happened, it caused a great deal of damage, so that would be severity. Severity is really high. So we can say that frequency is basically looking at how likely a loss is to happen, what the probability of that loss is, and then some events are lower frequency losses, some are higher frequency losses. Severity is, given I've had a loss, how much is it going to be? So obviously, if I have no loss, on the profile of frequency and severity, some risk management tools, including insurance, are better suited than others, as we will see a little bit later on. So, of course, insurance is a very common way of handling risk or uncertainty. And so we can see here that the definition you see on your screen, perhaps, is it's a means of treating risk by transferring the financial consequences of loss to a third party, and this third party is an insurance firm or an insurer. And it's also a means of protecting financial interests when losses do occur. So we're going to talk a little bit later about really what is the commodity, what is it that you're buying when you buy an insurance contract. So basically what you do when you buy insurance, you recognize that random events could happen to you that could cause you to have losses, and what you're doing is you're transferring the financial responsibility of that loss to a third party called an insurer. You're not really transferring the risk per se. If you own a property, if you own a house or a building, you are subject to various what we call property loss exposures. Your property could be damaged by a fire, right? You own that, so you'd be financially responsible for it. By buying an insurance contract, you still own the property, you still face the loss exposure, but now you've got an ally to help you pay for the financial consequences of that. So how do insurance and insurance contracts benefit insureds? So insured is, of course, one party to the contract. We have the insurer on the one hand and the insured on the other. Insurance contracts indemnify their customers. So basically, we could call insurance contracts of indemnity. There are other contracts of indemnity that are in the marketplace, but insurance is the most common example. So what happens when an individual has a loss is that insurers indemnify their customers. They provide a form of indemnification. To indemnify someone means to compensate them and perhaps to make them financially whole. But we'll talk more about that a little bit later. But basically, insurance contracts indemnify you. I have a loss, I file a claim with my insurer, and my insurer compensates me, they indemnify me. They provide some sort of financial resolution to that loss. It also reduces uncertainty in the sense that I know that if I have an insurance contract, in the event that I have a loss, which again, I don't know if I'm going to have a loss or not, I don't know how much that loss is going to be, but I know that in the event that I have a loss, that the insurer will provide some sort of financial restitution for that. So in a sense, it reduces the uncertainty. One could say that when you buy insurance and you pay a premium to an insurer, it's like paying a known loss. Without insurance, you are faced with a situation where you may or may not have to pay out a loss. With insurance, you pay a known loss in the form of a premium. It also encourages efficient use of resources. Imagine, if you will, if firms did not have access to insurance and they had to save money. They had to set money aside in very liquid form to be able to pay a loss when in fact it happened. That would perhaps be a very inefficient use of those resources. And also insurance and insurance contracts and insurers provide incentives to their customers to reduce and prevent losses. There are numerous examples of this in auto insurance and various types of property insurance and workers' compensation insurance. And many insurers actually are partners with their customers in those efforts. How does insurance benefit businesses and society? It supports credit. You as a bank would not loan money to someone, an organization or a business or an individual, if they did not have proper insurance on the asset that they were loaning money for. Also, it satisfies various legal requirements. Individuals, of course, have to have auto insurance in most states. Workers' compensation insurance is another. And, of course, a new requirement that has emerged recently is with the Affordable Care Act. Individuals have to have health insurance, and firms will have to provide health insurance to their employees beginning in 2015. It also satisfies business requirements. You may have a contractor that comes onto your work site or to your place of business or your home. You would want them to have adequate liability insurance to cover any losses they may have caused. Insurance firms are a big source of investable capital. They collect premium dollars, they pay losses out later, and depending upon the type of insurance, there may be opportunities to take those monies and invest it. And so insurance firms are a good source of investable capital for a lot of projects in the United States. And also reduces social burden. Again, imagine, if you will, a situation where people did not have access to insurance or insurance markets, and random things happened to them, either personally or to their property, and they would be destitute, for example, or they would be in need of various types of disaster relief or charity, and so it reduces those social burdens that might be forthcoming. What is the cost of insurance to insurers? Well, clearly the most obvious cost, or the direct cost, is premiums. Insurers, you have to pay premium dollars. That's money you give to an insurer, and certainly that has an opportunity cost, meaning the more money you give to an insurer, that is money that you can't use for an alternative purpose. You can't invest that in other assets. And so there is an indirect cost to buying insurance because you're tying up funds, if you will, with the insurance firm in the form of a premium when you may have an alternative use for that, which would be a positive gain. What are the costs associated with insurance? Well, clearly we have operating costs. Now, economists would call that transactions costs. So An insurance firm does provide contracts of indemnity. That's what they sell. But insurance firms do have operating expenses, right? They have employees. They have property they have to maintain. They have distribution expenses. They have advertising expenses. They have premium taxes that states charge them. And depending upon the type of insurance firm and how they're constructed or how they're formed, they may also include a profit. If it's a stock insurance company, they have investors. Investors should want a rate of return on their capital, so that insurance firms might make a profit. Another cost associated with insurance is, notice the next two have to do with hazards. So we have here moral hazard and then morale hazard. So I'm going to take morale hazard first and then come back to the moral hazard issue. So again, if you recall from our previous discussion, a hazard is something that increases either the frequency or the probability of a loss or the severity of the loss. So it makes losses more likely to happen, or it makes losses more severe than in the absence of the hazard. There are some physical hazards, of course, but then there are also these things called morale and moral hazards. So we'll look at the third bullet point, morale hazard, first. So these basically are types of claims or losses that are caused by carelessness or indifference on the part of the insured. So individuals who perhaps text while they're driving, or people who don't lock up their property, or students I have who are in the tech center on campus and they have iPads and iPhones and laptops and they walk off and leave them because they're just very forgetful. Those are types, and then they're stolen afterwards. That's a morale hazard issue. But then we also have this issue of moral hazard. So I want to spend a little bit of time on this because moral hazard is an important part of any insurance transaction. So moral hazard, the classic examples would be, as you can see here, fraudulent activity, inflated claims, things we would probably call insurance fraud. And those are definitely examples of moral hazard. Arson, murdering someone for life insurance proceeds, those are examples of moral hazard. And the reason why they're called moral hazard, I suspect, is because this activity involves behavior which is morally suspect. However, there are other examples of moral hazard in insurance contracts. So, for example, if someone becomes unemployed, maybe they become unemployed through no fault of their own, and they have 18 months of unemployment insurance, then they may be not very careful about looking for a job. They may not be as diligent about looking for a job as they would be if they didn't have unemployment insurance. So even though unemployment insurance may not have caused them to become unemployed, the fact that they're not aggressively looking for a job, that is actually increased the severity of the loss, and that would be considered a moral hazard as well. So what I like to think of moral hazard is I think, well, moral hazard is when someone has insurance or things that look a whole lot like insurance, like disaster relief, then their behavior changes. And their behavior changes in a way to increase frequency or severity of losses. I'll give you one more example of what I would consider to be moral hazard. When I give an exam to my students, and if the average is 65, they all want to know, well, is there a curve or not? If I gave them a 10-point curve, I've just given them something that's like insurance. I've given them great insurance. And so if I give them a 10-point curve to bail them out because they didn't study as much, they probably won't study as much next time. So that gets to behavior change. So moral hazard is something that is prevalent in all types of insurance. It's just a matter of how much moral hazard there is and what degree it is. So what we worry about a lot in controlling insurance contracts is controlling moral hazard. So again, moral hazard would be the case where someone's insured and that changes their behavior in a way to increase frequency or severity of losses. Sometimes that behavior change is immorally illegal or against the law, and sometimes it's not. Frivolous lawsuits that are settled as nuisance claims, that's also a cost associated with insurance. One would imagine there wouldn't be as many frivolous lawsuits if people didn't have insurance. So that's also an example of moral hazard as well.
Thanks, Rob. And we've arrived at the first of our 3 polls for our audience. The question we have is, which of these costs is an indirect cost of insurance? The poll will be open until all attendees have responded, or 30 seconds, whichever occurs first. The options include A, opportunity cost, B, fraudulent claim cost, C, moral hazard cost, or D, frivolous lawsuit cost. And the results are in. Rob, it looks like 75% of our attendee audience chose option A, opportunity cost.
Yes, thank you, Marty. This opportunity cost is the correct choice. It's not a direct cost of insurance, but it's an indirect cost, because if individuals or firms buy insurance, they have funds tied up with an insurer. There's an alternative use for those, and so that is what we would call an indirect cost associated with the insurance transaction. The fraudulent claims costs, moral hazard, and frivolous lawsuit costs, those are just costs associated with insurance. Those are going to be present depending upon the type of insurance, no matter what the circumstance. Now we turn our attention to some fundamental insurance principles. And these are really important principles in terms of an insurer's ability to write insurance contracts. These include a discussion of indemnification, which of course is a variation on the word indemnify. There is a statistical concept called the law of large numbers, and then there is a legal concept called insurable interest. So as I mentioned before, insurance contracts are contracts of indemnity, and there's a fundamental principle that permeates all insurance contracts called the principle of indemnity. And basically, this says that in the event of a loss, that the insured, that's the one party to the contract, should basically lose financially. And so we should not be, when we indemnify them, we should not indemnify them more than what their loss is. So as you can see here, insurance should not benefit an insured beyond the value of the loss. So to give you an example, suppose you had a five-year-old car, and you were involved in an auto accident and it was totaled. And then you file a claim with your insurer. Your insurer indemnifies you. The question is, how much should I indemnify you? Well, I should not give you a five-year-old car. I should not give you a new car. I should give you the value of a five-year-old car. If I gave you a new car, then all of a sudden the amount I indemnify you is greater than the loss you had, and this would want you to cause losses to happen. And so if you would be over indemnified, or you would profit from a loss, and this would violate the principle of indemnity, saying that you should not profit from the loss, and this would make you want to have losses, or you would exaggerate the amount of the loss, so it would increase the frequency or severity of the losses. So what this basically does, if we over indemnify you, we've now made the moral hazard problem much worse. So one of the reasons why we have the principle of indemnity is to control the moral hazard problem that I mentioned. The next item is the law of large numbers. Clearly, insurance is unique in that insurers have to make forecasts about the future. So what an insurance firm does is they form risk pools, as we'll see, and they have various types of exposures or exposure units. So they could be as cars or drivers or property in these risk pools, and they have to make a forecast or determination of future losses for the risk pool in total. To do this is they use the law of large numbers, which is a statistical theorem. And the law of large numbers basically says is that if you're going to use past information to predict the future, which is what insurance firms do, and you want to have accurate estimates about the future, then you need a lot of past information to do so. This is sometimes called the law of averages. So if it weren't for the law of large numbers, insurance firms would not be able to sell contracts that indemnify their customers. And notice that because of the law of large numbers, the insurance coverage provided to you, which you might think of as the face amount of the contract, is relatively large compared to the small premium that you pay. And that good outcome is the result of the law of large numbers. One way to think about insurance is that insurance is a situation where individual losses become collectively predictable. And so what would be an unexpected loss for an individual becomes an expected loss, and they just predict with a pretty high degree of accuracy in aggregate for an insurer. Another important concept that backs up insurance contracts is insurable interest. And so anytime you have an insurance contract, one thing the insurer is going to look for is there an insurable interest present? What that means is that in the event of a loss, the insured should lose financially or incur some other type of harm. And so I give my students an example regarding insurable interest. I tell them that I own a home. I tell them the name of my insurer. I tell them how much I pay for homeowners insurance, and I tell them my insurance agent's name and phone number. And I tell them that I'll give them an A if they can go out and insure my home by the next class. Of course, they can't because none of them have an insurable interest in my home. So if they could insure my house, if they could insure an asset they did not have insurable interest in, then of course they would want the loss to happen, and they might collectively burn my house down to gain from that. They would not suffer a loss, they would gain. So notice that if that were the case, they would be over-indemnified, and that would also create a moral hazard. So you can see here that moral hazard is once again controlled by having and enforcing the insurable interest concept. Insurance pricing is very different than pricing other types of goods or commodities. So you think about insurance pricing, if I'm going to price any commodity, I've considered the cost of goods sold. If I'm pricing an insurance contract, I know some of my costs. I have administrative costs, I have salary of employees, but my primary cost is losses or claims. I have to price a contract now. I deliver it to you now. It covers a particular time period. You may or may not have losses. So part of the cost of goods sold that I have are not known to me when I price it. That's very unique in terms of pricing products. So basically what the cost of goods sold for an insurer would be the claims or the losses, whatever expenses or the transactions cost they have, perhaps an allowance for profit, and then this thing we call contingencies. Contingencies would be there to reflect the fact that we do have to estimate future costs.
Well, thanks, Rob. And now we'd just like to take a moment for the audience to put some of this in context. And the question we pose to do that is ask, what do you think? What issues affect insurance market pricing? So while you're considering that, let's kind of go over some very elementary issues that arise with respect to pricing insurance contracts. Because remember, you think about, if I'm an insurance firm, I have to price the insurance contract in terms of cost of goods sold, what are my losses, what are my expenses, and then contingencies. So there are some critical things that arise here, something called adverse selection. Again, we'll revisit moral and morale hazard. We'll also talk about equity, something called actuarial equity and social equity, and then the timing here. So adverse selection is a problem in insurance markets. So I'll give you a simple example here. Suppose I'm an auto insurer, and I have an auto insurance contract I'm marketing to a set of customers, and I think that all the people who are going to buy this contract are going to be what we call good risks for auto insurance, very, very healthy drivers. And let's say I price that coverage, I price that insurance contract with that assumption in mind. If, however, we'll take two cases. If the people who actually buy the auto insurance are low-risk drivers or good drivers, then that's good. I price it accordingly. If they are not low-risk or high-risk drivers, so high-risk individuals buy this insurance contract, then that's a problem for me. So in the selection process, who is purchased and who hasn't, the results are adverse to the insurer. So adverse selection basically arises when you have high-risk people in your risk pool who are not necessarily paying high-risk premiums because they have not been identified as high risk. This is a real problem for insurance firms. This is a problem that arises before the contract is issued.
So how does an insurance firm control the adverse selection problem? Well, they do it through a process known as underwriting. So you go to an insurance firm, you say, I want to buy insurance. The insurers have to figure out what your level of risk is. You're transferring a risk to them. To do this, insurers need information about the risk. They need information about the risk that's being transferred to them, about the insured, about the insured's property, about the insured's driving history, et cetera. And so they need information. Information is key to controlling adverse selection. So, of course, the question becomes, so the public policy issue is, well, what information is relevant? I mean, there might be some information that the insurer has that's not relevant to that decision to assessing your level of risk, and then how much information is too much. So there might be information that the insurer collects that may not be useful to that, or it may be. Now, with the rise of data analytics and big data, insurance firms are able to collect lots of information, and by having information about the risk, insurers can have homogeneous risk pools, and we'll see that's important, and they're able to control the adverse selection problem better. If insurers do not have information about the risk and they're not able to correctly classify insureds, then the insurance market breaks down. The law of large numbers, for example, breaks down. Another two items that we've already touched on, morale and moral hazard. So again, these are behaviors that increase the frequency or severity. Moral hazard oftentimes is dishonest behavior like insurance fraud, but it's a more general change in behavior when insurance is present. So again, there are cases where moral hazard involves dishonesty, but it doesn't always have to. A morale hazard is just carelessness or indifference causing that. Now, you do see a lot of insurance fraud, for example, in various types of automobile insurance. There could be products liability, general liability insurance. There could be moral hazard issues there. Moral hazard is always going to be present no matter what type of insurance you have. A common way, not the only way, that insurers control moral hazard. We've already seen they control it through insurable interest and the indemnity requirement, but they usually control it by having deductibles in the contract. So insurance firms are very reluctant to provide insurance coverage which would fully indemnify their customers, 100% coverage, because then losses are free. If you have deductible in a contract, then if it's a certain value, losses are all of a sudden not free.
Thanks, Rob. And we have arrived at our next poll question. Our question is, what is the most common way to reduce moral and morale hazard? You will have 30 seconds to answer this question, and the options include A, avoid writing the policy, B, apply a deductible in the policy, C, collect additional data about the risk, D, increase the premium to reflect the hazard. If you haven't done so, please take a moment to select one of these options. Thanks. Rob, the results are in. 86% of our attendees chose option B, apply a deductible in the policy.
That is the most common way to control moral hazard. One could argue quite successfully that collecting additional data about the risk is a way to control moral hazard to the extent that moral hazard is related to insurance fraud. But applying deductible is the most common way in which it's controlled. Now we turn our attention to, I think, an important public policy issue, actuarial equity versus social equity. So in the underwriting process, the information collection process, insurers collect information about the risk, and they may have two individuals who are buying the same insurance contract, and they may charge them different rates for the same, or different premiums for the same insurance contract. So in a sense, they are discriminating against them. In other words, they're treating them differently. So the question is that fair discrimination or is that unfair discrimination? So we have to think about, well, from an actuarial perspective, the more risk that you're transferring to an insurer, the more they should charge you for that. So if you are a really high-risk driver, we should probably charge you more for auto insurance than if you're a low-risk driver. So that, we would say, is an example of fair discrimination, and that's really essential to insurance pricing. State laws, of course, do prohibit unfair discrimination in insurance pricing. So state laws would say, well, we can't really charge different people auto insurance, different rates for auto insurance based on their religion or based on the color of their hair. So really, when we talk about what is fair and unfair discrimination, of course, opinions would vary widely on that, perhaps. So for actuarial equity, we can think of this as basically where the premium you pay has a very direct function to the level of risk that you're transferring to an insurer. It's also called cost-based pricing. It's also called actuarial-based pricing, or what I like to call it, risk-based pricing. So the more risk that you're transferring to me, the more I should charge you for that. Now, to figure out how much risk you're transferring to me, I have to use risk classification variables. And some variables may be prohibited by state law. A good example of a somewhat controversial risk classification variable could be gender rating. So some states are not allowed rates to be differentiated by gender. Social equity, kind of related to this, social equity says, well, pricing should be related to ability to pay, and factors beyond an insurer's control, like someone's gender, should not affect the premium. So we don't really have a problem with charging high-risk drivers more for auto insurance, but we may have a problem charging one driver or another a different premium based on their gender. Timing is also important. Depending upon the type of insurance contract, there's maybe a long time period between when the premium is collected, when the insured for event happens, and when the loss is actually paid. So some types of losses are what we call short tail losses. So property insurance is a good example there. I own a property, it burns, they come adjust the claim, they figure out what the loss is going to be, it's settled, and the property is rebuilt. We're kind of done pretty quickly there. But then there's some types of loss exposures that are long-tailed losses. So liability lawsuits tend to be long-tailed because it may take a long time to determine the extent of the damage, especially a property bodily injury when the case is settled. Workers' compensation losses could be long-tailed. Someone is severely injured and they have to keep paying them. So from an insurance firm perspective, it makes forecasting the losses, the ultimate losses, more difficult the longer the tail is. So there's more uncertainty involved there when you have a longer tailed loss. So now a good question to ask, I think, is, well, what is an ideally insurable risk? In other words, so some risks lend themselves toward being insured and some don't. There are 6 characteristics of ideally insurable risk. Some risks meet these characteristics ideally, some don't. If they don't meet them, then there has to be something used to address the deficiency. So, for example, in the contract, an insurer should only select those risks that meet the criteria. If they don't follow these insurable risk guidelines, then they have the possibility of becoming insolvent. So the first of these is that if we're going to form risk pools, there should be a large quantity of similar people or objects that may be subject to a loss. So we can say that the risk pool should be similar or homogeneous, and so we can use the law of large numbers to correctly classify the risk and to predict the expected loss. We need underwriting. We need to be able to do risk classification to determine what risk pool someone is in. So if we don't use underwriting variables, then we have risk pools that are heterogeneous risk pools, and we are open to the possibility of having an adverse selection problem. The loss should be fortuitous, meaning that the loss happens randomly, but this also means there should be no moral hazard. Of course, we know there is moral hazard, but we already know how insurers can solve that problem. The loss should not be catastrophic in nature to the insurer, so one event happening should not cause multiple losses to happen at the same time. Insurance firms run the risk of bankruptcy when that occurs. But insurers have access to reinsurance markets, and that's one way to address that issue. To the extent possible, the time, location, and extent of the loss can be determined, so the loss should be definite. It should be determinable. It's kind of hard to insure losses if you can't tell where they've actually occurred. The amount of the expected loss can be predicted, so we have to be able to predict losses. If we have a lot of estimation risk, then insurance becomes more expensive as a result of that. And covering the loss, expected loss, is economically feasible for the insurer. So basically what this is saying is that the insurance firm charges enough to be able to pay out the ultimate loss should the loss happen. Now, characteristics of the insurance product, again, there are some distinguishing features of insurance products that that are different from other types of products. So three things that come to mind is, one, when you buy an insurance contract, you pay all this money, they give you paper or they give you a PDF document with your insurance contract on there. And so it really lacks a physical characteristic. It's much more than the policy on paper. And basically what you're buying is you're buying certainty in loss costs, or you're buying a promise. So in the event of a loss, the insurance firm promises to pay a loss that you would otherwise be financially responsible for. So again, buying a promise, I think, is a critical part of what you buy when you buy an insurance contract.
Okay, thank you, Rob. We'll take a moment, just food for thought for our audience. What do you think? How does the complexity of the insurance product get in the way of consumer satisfaction? And factors involved there might involve the notion that customers don't understand the terminology used and often do not understand the benefits provided by the policy or the way the policy works.
Right, so I suppose if you wanted to put yourself to sleep at night, you might start reading an insurance contract, something that most people don't do. So we'll note here that an insurance policy contains very complicated terms and concepts, and notice that the buyer of insurance typically has no role in writing those contracts either. It is a legal contract, and as such, issues arise regarding claims and so forth that have to be settled in the courts, perhaps by regulators, and there may be some legislation that is passed in order to settle those issues. So it is a complex legal document. The benefits of having insurance are not necessarily apparent to the buyer. It's sort of deferred gratification, a gratification that may never come, right? Because you buy an insurance contract, you're very glad you have insurance when an unfortunate circumstance arises, when you have a loss. So it's very different than buying food, for example, where you have immediate gratification. Now we'll look at, we'll kind of frame our discussion a little bit in terms of how insurance fits in as a risk management technique for firms and individuals and organizations.
Let's take a moment for another question for the audience to ponder. What do you think? What are some typical techniques people or companies use to manage risk? And we can know that at one end of the risk continuum is to retain or avoid loss exposures, and at the other end is to transfer loss exposures to another party. Between the two are various activities aimed at risk mitigation.
Okay, so we think about how a firm or an individual manages risk, so-called risk managers. There are various tools available to them, and these are not mutually exclusive. So the first bullet and the last bullet really have something in common. Those are basically looking at, okay, if we have a loss of some kind, who is going to pay for it? If we retain that exposure to loss, we pay for it. If we transfer that to a third party, someone else pays for it. Avoidance and control, which would include loss prevention and loss reduction, are what we call risk control techniques. Those are what someone might call proper risk management. So, for example, there's a big difference between buying auto insurance as a way to manage your auto risk versus being a safer driver and inflating your tires and not driving in the rain and wearing a seatbelt. Those are all ways to manage the loss exposure itself. Those are all considered to be risk management. So one thing we might do as a firm and organization is we might retain the loss exposure. And so what that means is, in the event of a loss, we will be financially responsible for it. We're not going to transfer that to a third party. Some loss exposures need to be transferred. Some can be retained. It basically boils down to how predictable they are and if we can afford to pay for them themselves. So one of the things that I always tell my students is, if you have a loss exposure that you can predict with a high degree of accuracy and you can afford to pay for it yourself, then you should probably consider retaining that exposure to loss. Sometimes retention programs are viewed as deductibles. That's part of retention. And sometimes firms have what we call a formalized self-insurance program, and that's also an example of retention. Some loss exposures are so severe that we might consider avoiding those loss exposures. So avoidance would be, well, we cease to engage in an activity causing a loss, or we never engage in that activity causing a loss. So example, not owning or driving an automobile eliminates potential auto liability loss. So you can avoid that by not participating in the activity, or if you're currently participating in it, you stop doing so. Avoidance is somewhat of an extreme measure. We think of avoidance really being sort of the last-ditch risk management solution in terms of those loss exposures that are higher frequency and higher severity. A lot of firms getting involved in controlling loss control mechanisms. There are two basic examples here. Loss prevention, for example, with respect to workers' compensation losses, reduces perhaps the frequency of injuries that happen. We're trying to take steps to reduce the frequency, so safety programs or training programs, and then loss reduction reduces the severity of losses. So an example here is fire losses, right? So having a fire extinguisher is an example of a loss reduction. Doesn't prevent a fire from happening, but once a fire does occur, then it reduces the severity of that. Of course, we may be involved in transferring risk. By what we mean here is we transfer financial responsibility of a loss that we would normally be responsible for. We transfer that to someone else. We might do it through a contract. We might do it through lease agreements. We might do it through hold harmless agreements. But a very common example of a legal agreement where we're transferring financial responsibility, of course, is to buy an insurance contract. This is a very common way where we transfer financial responsibility to a third party, and that third party is an insurance firm. So one of the things that comes up is insurance firms being regulated. Why are they regulated? I would say the short answer is that insurers are regulated for many of the same reasons that banks are regulated, because they involve a lot of trusts. So the classic reasons why we posit that insurance firms should be regulated is to protect consumers and to maintain insurer solvency and to prevent destructive competition. These are all sort of roll into one. The basic reason why insurance firms are regulated is to prevent insolvency. Consumer protection, again, we noted before that insurance contracts are complex legal documents. Most people don't have the interest, for example, or perhaps the ability to read and understand an insurance contract. Buyers of insurance typically do not negotiate with insurers over terms of the contract, especially in personal lines insurance. So it's felt that because of that's the case, and because you're buying an intangible product, the results of which you may not see for a long period of time, if ever, then regulating these insurance policies and products is important, and also standardizing them too. So if you're buying an auto insurance contract in the state of Pennsylvania, it should look like every other auto insurance contract in the state of Pennsylvania from whatever insurer you buy it from. It's easier to compare apples to apples if the products are standardized. We also want to control market conduct and prevent unfair trade practices. So misrepresenting coverage to a particular insured, refusing to pay claims, those would be sort of bad market conduct issues. And then we also want to make sure that insurance is available and affordable, especially if we have a situation where individuals are required to purchase insurance. So you kind of see this, you've always seen this in the auto insurance market. I'm beginning to see this more at the state and the federal level in the health insurance market, since individuals have the individual mandate now to buy health insurance. Insurance solvency regulation, again, what you have to think about is I give money to an insurer at one period of time. They promise to pay my loss should it happen at some future date. If it's a long-tail loss exposure, that future date could keep coming and coming and be a long period of time in the future. So as a regulator, we want to make sure that insurers are able to honor that promise. They're able to pay the claims. They have to, first of all, be in business to pay the claims, and secondly, they have to have enough money to pay those and pay them in a fair manner. Imagine, if you will, a situation where insurers became insolvent. People lost trust in insurance as a mechanism, and so people would not buy insurance because they would not have faith in the insurer's ability to pay those losses. And then insurers hold short and long-term investments, and the security of these is really essential. If making sure that insurers are investing in safe assets so that when those assets are needed to pay claims, they are in fact available. We also want to prevent insurers from engaging in destructive competition. Competition is good, but we don't want a situation where insurers are competing for market share. To get market share, they lower rates. Lowering rates is not necessarily a bad thing, but lowering rates below what are needed to cover their costs would be a bad thing. So they engage in sort of competition-induced death spiral where they're basically selling products that they're selling at a loss. If they do that constantly and continuously, then insurance firms will become insolvent, or there will be an insurance shortage as a result as insurance firms pull out of the marketplace.
Thanks, Rob. And we've arrived at our third and final poll for today's session. This question, regarding insurance regulation, regulators seek to protect consumers by, answer choices include A, preventing fraud and unethical market behavior by insurers and producers, B, restricting availability of types of insurance they view as unnecessary, C, eliminating all insurer insolvencies. Again, you will have up to 30 seconds to complete this poll. The results are in. 88% of our respondents chose A, preventing fraud and unethical market behavior.
And Marty, that is the correct answer. Even though it would be nice to eliminate all insurer insolvencies, that is possible. We want to minimize insolvencies. Insurers don't necessarily restrict the availability of types of insurance, but they may guide insurance firms as to what is appropriate in terms of contracts and pricing. But preventing fraud and unethical behavior by insurers and producers, that's one way they protect consumers. So to summarize our discussion today, we've noted that insurance is a risk management technique that involves transfer of risk or financial responsibility to a third party called an insurance company. Insurance contracts, by their very nature, are complex legal documents that are supported by various principles and statistical concepts. The insurance market transaction, pre and post contract being issued, are affected by such issues as adverse selection, which involves underwriting, of course, controlling moral and morale hazard, actuarial and social equity in terms of rate making, and then the timing of the loss payments. And it's regulated to protect consumers and policyholders.
Rob, thanks for that. We have just a few moments left, and in that time, we do have a couple of questions. First question is, what % of premium dollars get paid back as claims?
Well, that's a good question. That's what we would call a loss ratio. So for every dollar I collect in premiums, what percentage of that is going to pay out losses or claims as opposed to administrative cost or profit? The answer is not 100%. It's not 100% of every dollar that an insurance firm collects is supposed to pay out losses. Insurers have expenses. Loss ratios do vary widely depending upon the type of insurance. So, for example, if an insurance firm has 20% paid in expenses and profit, then 80% will be paid out in losses. So it does vary depending on the type of insurance. The more competitive insurance markets tend to have higher loss ratios. Higher loss ratio is not necessarily a bad thing. That's actually a measure of efficiency of the insurance dollar being spent. I will comment on the Affordable Care Act as part of legislation that insurers, depending upon what marketplace they're involved in, small group or larger group market, they have to maintain an 80 or 85% loss ratio.
Thanks. And we have one more question. You had mentioned that the insurance premium covers the amount to pay losses plus loss adjustment expenses, other overhead, and profits. So the question is, how do most states handle excess insurer profits?
That perhaps depends on how you define excess, but to the extent that states and regulators and public policy officials are worried about that issue, Many states do regulate the rates that insurers can charge, especially for types of insurance that are personal lines or that are more widely purchased as opposed to business insurance. So auto insurance is a good example, depending upon the state. Some states do have rating laws, prior approval laws, and so forth that really guard against excessive rates on the part of auto insurers, in my example.
Well, Dr. Drennan, thanks for those answers, and thanks for joining us today and sharing your expertise with our audience. Thanks also to all of you who attended this session. We appreciate your participation in our soft launch. Within a few days, you will be receiving an email message from us with a link to a post-event survey. Please remember that we need your feedback. This is your opportunity to help shape the development of these new delivery options. As a reminder, this was the first webinar in a 4-part series. Our next webinar will be on Tuesday, July 8th at noon Eastern Time. Dr. David Eccles will present insurance coverages, property and casualty. At noon on Monday, July 21st, Dr. Drennan returns with insurance coverages, life and health. Our series concludes on Monday, August 11 at noon when Dr. Eccles presents insurance regulation and legislation. You can register from links in the email we sent or simply visit www.griffithfoundation.org. Thanks again for joining us. This concludes today's session.